In the last video, we talked about what happens when you deposit money into a bank. Your money doesn't just sit in a vault, it starts moving through the financial system. But what happens next is even stranger, because that same dollar you deposited doesn't just get loaned once. It can be loaned again and again and again, which raises a question that sounds impossible. How can one single dollar create multiple dollars inside the system? It sounds like a trick, but it happens every day. Stay with me until the end, and I promise I'll walk you through it. And don't forget to hit subscribe and leave a comment below. Let's start at the beginning. You walk into a bank and deposit $1, just one. Your account balance now shows $1. That number matters because it's what you can spend, but the bank does not lock your dollar in a box with your name on it. Instead, the bank keeps only a small portion as a safety buffer, let's say 10%. So the bank holds 10 cents in reserve. The remaining 90 cents can be loaned out. The bank lends that 90 cents to someone else. That borrower spends it, and whoever receives that money deposits it into their own bank account. Now pause for a moment. You still see $1 in your account, and now someone else sees 90 cents in theirs. No new paper money was printed, but there are now more dollars showing up in bank accounts. That's the key shift. What's multiplying here is not cash, it's bank deposits. Now the process repeats. The second bank receives a 90-cent deposit. It keeps 10%, 9 cents, as reserves, and it lends out the remaining 81 cents. That 81 cents gets spent, and then deposited again. A third bank keeps a small slice, loans the rest, and the chain continues. Each step looks boring on its own. A small reserve kept, a slightly smaller loan made. But when you stack those steps together, something big happens. Let's run through the numbers quickly. You start with a $1 deposit. 90 cents gets loaned, then 81 cents, then about 73 cents, then 66 cents. Each loan is smaller than the last, but each one creates a new deposit somewhere else in the system. When you add up all those deposits across all the banks, you get a surprise. That original $1 can support close to $10 of total deposits. This pattern is called the money multiplier effect. With a 10% reserve, the system can build up roughly 10 times the original deposit in account balances. Again, not in cash, in spendable bank money. At this point, a lot of people get uneasy. If banks are creating money like this, doesn't that mean it's fake? Not exactly, because every new dollar created in this process comes with a matching obligation, debt. When a bank makes a loan, two things appear at the same time. The borrower gets a deposit they can spend, and the bank gets a loan that must be repaid. For every dollar created, someone owes a dollar back, plus interest. And when loans are repaid, the process runs in reverse. The deposits used to repay the loan disappear. The money supply shrinks. So lending expands money, repayment destroys it. The system is constantly growing and contracting based on how much people borrow and how much they pay back. That's why this doesn't automatically spiral out of control. But there's something even more important holding it together. Trust. Trust that borrowers will repay. Trust that banks manage their risks. And trust that not everyone will demand all their money at once. Because here's the final piece that clears up the mystery. The dollars in your bank account are not physical bills. They're promises. They're the bank saying, we owe you this amount. As long as people trust those promises, they function as money. That's why deposits can multiply even though cash does not. Now, one quick reality check. This step-by-step multiplier story is a teaching model. In the real world, banks don't literally wait for your deposit before making a loan. They lend when it makes business sense, and they sort out reserves afterwards through the banking system and the central bank. What actually limits lending today isn't a simple reserve percentage. It's things like credit risk, regulations, interest rates, and profitability. But the core insight still holds. Most of the money we use is created when banks make loans, and that money exists as numbers in accounts, backed by debt and trust. So $1 doesn't magically turn into 10 physical dollars. It turns into many promises to pay, promises that circulate, promises that fuel businesses, homes, cars, and entire industries. And if money is built on promises, the next question becomes obvious. How do banks decide who gets trusted with those promises? If an invisible system can multiply money like this, wait until you see the invisible number that follows you everywhere, your credit score. That's next. After all, we're just asking, aren't we?